Let's talk about tariffs, a word that suddenly became headline news in 2025. That year, the Trump administration rolled out a sweeping universal tariff, a 10% tax on most imports, with some products facing up to 50%. So what's a tariff? Think of it as an entrance fee for foreign goods, making imports more expensive at the border. The goal? Protect American industries and jobs by making foreign products pricier, hoping people would buy American instead. But the global economy is a tangled web. Even American products rely on foreign parts, so tariffs hit everything from cars to smartphones. Instead of a manufacturing boom, the policy triggered economic anxiety and unexpected costs, about $24 billion hitting ordinary Americans' wallets. This wasn't just a policy debate, it was a real-world test of economic theory, and the early results were troubling. It set the stage for a dramatic showdown between the White House and the Federal Reserve. In 2025, if your grocery bill felt higher, you weren't imagining it. The 10% tariff made imports pricier, and companies passed those costs to consumers. American-made goods got more expensive too, since they rely on foreign parts. With less competition, domestic companies could raise prices as well. The result? Inflation surged, with the Fed estimating tariffs added up to 2 percentage points to core inflation. Prices rose for groceries, cars, electronics, almost everything. Families expected relief, but the cost of living kept climbing, squeezing budgets and eroding wages. The dream of a soft landing for the economy faded. Tariffs, meant to protect, ended up hurting the very people they were supposed to help. The policy became a self-inflicted wound for American households. Enter the Federal Reserve, led by Jerome Powell, tasked with keeping inflation low and jobs plentiful. The Fed planned to cut interest rates to help the slowing economy, until tariffs reignited inflation. Tariffs caused cost-push inflation, making goods more expensive to produce, not just more in demand. The Fed's tools are designed to cool demand, not fix supply shocks. Powell told Congress, if not for tariffs, rate cuts would have already started. But with growth slowing and inflation stubbornly high, the Fed was paralyzed. Cutting rates risked fueling inflation. Raising them risked recession. The economy sputtered, families faced high borrowing costs, and businesses were left in limbo. The Fed was stuck, unable to help without making things worse. The tariff shock left the central bank with no good options. Americans paid the price for this economic stalemate. As the Fed held rates high to fight inflation, President Trump lashed out, publicly attacking Jerome Powell and threatening to remove him. The independence of the Fed is crucial. It lets the bank make tough calls without political interference. But Trump's threats rattled global markets, sending Treasury yields soaring and borrowing costs up for everyone. Ironically, attempts to pressure the Fed into lowering rates made credit even more expensive. Allies in Congress tried to make it easier to fire the Fed chair, escalating the political drama. This wasn't just a war of words, it was a direct assault on the foundations of American economic policy. The world watched, wondering how much pressure the Fed could withstand. Tariffs quickly became a nightmare for American factories and businesses. At Tesla's Texas Gigafactory, tariffs on imported parts caused costly delays and production slowdowns. Foreign competitors filled the gaps, turning a policy meant to help American industry into a win for rivals abroad. Across the Midwest, factories ran less often, and job growth slowed. In May 2025, job gains fell short, and wage growth stalled. Workers faced a double hit: higher living costs and a weaker job market. The promised manufacturing renaissance never arrived. Instead, tariffs became an anchor, dragging down businesses and workers alike. The tariff fallout didn't stop at America's borders. The Fed's high rates strengthened the dollar, making U.S. exports pricier and hurting American exporters. Developing countries, facing capital flight, hiked their own interest rates to defend their currencies. The global ripple effects were severe. Emerging markets struggled with debt and growth slowed worldwide. Trust in the U.S. as the world's financial anchor began to erode. BRICS plus nations accelerated efforts to build alternatives to the dollar. The tariffs weren't just a trade issue, they shook the foundations of the global economic order. America's policy choices sent shockwaves across the world. Fed Chair Powell was caught between economic chaos and political attacks. Internal government rifts emerged, with some agencies pushing to ease tariffs, but the administration refused. Powell floated a lower tariff rate to reduce inflation, highlighting the desperate search for solutions. The Fed shifted its messaging, focusing on long-term stability over short-term data. It also slowed its balance sheet reduction to prevent a spike in long-term rates. These moves were risky, injecting more liquidity and fueling speculation. Powell was forced into messy compromises, fighting to keep the system stable. The Fed's independence was under siege from all sides. Why does this matter to you? Because the Fed's independence protects your savings and your future. If politicians control the Fed, we risk runaway inflation, stagnant wages, and economic chaos. Political interference destroys trust, raises borrowing costs, and acts as a tax on everyone. Your mortgage, car loan, and credit card rates all go up. The economy slows, and uncertainty reigns. The Fed is like a pilot. It needs control to steer the economy safely. If it's locked out of the cockpit, we're all in danger. A compromised Fed can't protect against inflation or recession. We're left hoping for the best, but fearing the worst. By summer 2025, America faced a crisis of its own making. Universal tariffs fueled inflation, hurt businesses, and slowed growth. The global fallout was severe, and trust in U.S. institutions wavered. But the deeper damage was the political assault on the Fed's independence. The central bank was forced to keep rates high, even as the economy weakened. With Powell's term ending soon, the risk of a compliant successor loomed. Markets braced for more instability, and the threat of a wider trade war grew. This saga proves central bank independence isn't a technicality, it's a safeguard for your prosperity. When that firewall is dismantled, everyone gets burned. The Fed's ability to act freely is more vital now than ever.